So you're following the market, and you know that big news about a company, good or bad, can send its stocks soaring or tanking. But what about all those other days? The ones where there's no major company announcement, yet the entire market is on a roller coaster. Well, that's because the real story, the one that truly pulls the strings, is often happening way beyond the headlines. And today, we're going to dive right into what's really going on.
I mean, it's a classic question, right? You pull up your trading app, you check the news feeds, and nothing. No giant mergers, no scandals, no blockbuster product launches. Yet the Sensex or the Nifty is up or down by a huge margin. It can feel totally random. So what on earth is going on?
And here's the answer, plain and simple. The most powerful forces that shake up the market don't come from a single company's quarterly report. They're way bigger than that. We're talking about massive economic tides and sometimes completely non-economic events that affect literally everyone.
Okay, so let's start with the most powerful player in this whole game, the central bank. Think of them as sitting at the economy's master control panel. For us in India, that's the Reserve Bank of India, or the RBI. In the US, it's the famous Federal Reserve. The decisions they make, the buttons they push, send massive ripple effects through the entire financial system.
Now, the job of a central bank is this constant, tricky balancing act. On one hand, they want to hit the gas pedal to fuel economic growth. How? By lowering interest rates. That makes it cheaper for businesses to expand and for you to get a loan. But if they push that pedal too hard, too much money starts chasing too few goods, and prices for everything go up. That's inflation. To fight that, they have to hit the brakes by raising interest rates to slow spending down. It's a real tightrope walk.
So what are these pedals exactly? Well, the main brake pedal is something called the repo rate. In simple terms, this is the interest rate your bank pays to borrow money from the RBI. So if the repo rate goes up, it gets more expensive for your bank, and you better believe they're going to pass that cost on to you and to businesses. That's why the market usually gets nervous about a repo rate hike. It's the central bank's signal that they're about to slow things down.
And then there's the other side of the coin, the reverse repo rate. This is the rate the RBI pays to commercial banks when they want to park their extra cash. Think about it. If the reverse repo rate is high, a bank might think, why take a risk lending to a company when I can get a decent, risk-free return from the central bank? A higher rate here effectively encourages banks to lend less, which tightens up the money supply in the economy.
And the third major tool in their kit is the cash reserve ratio, or CRR. This one's pretty straightforward. It's a rule that says for every 100 rupees you deposit, the bank has to keep a certain amount, say 4 rupees, locked away with the RBI. They can't lend that money out. So if the RBI raises the CRR, it directly reduces the amount of money banks have available to loan out, which, you guessed it, slows the economy.
So if central banks are constantly reacting to the health of the economy, how do they actually measure it? Well, they're like doctors, and they look at a few key vital signs. Let's go through the most important indicators they and the entire market are watching like a hawk.
The first and arguably the biggest is inflation. We've all felt this. It's when your money just doesn't go as far as it used to. That cup of chai that costs 10 rupees is suddenly 12. While a tiny bit of inflation is considered healthy, high inflation is a huge red flag. It eats away at your savings and creates a ton of uncertainty, which markets absolutely hate. Now, how do we track this? Well, there are two main numbers. You might hear about the Wholesale Price Index, or WPI, which looks at prices at the factory date. But honestly, the one that really matters to you, me, and the RBI is the Consumer Price Index, or CPI. This measures the price changes of the stuff we actually buy: food, fuel, housing. It's the true reflection of how inflation is hitting our household budgets.
Next up, we have the Index of Industrial Production, or IIP. This is a monthly report card for the country's industrial sector. Are our factories making more cars? Are they producing more steel? Are they churning out more goods? A rising IIP number is a fantastic sign, suggesting the industrial heart of the economy is pumping strong. A falling number, well, that's a clear signal of a slowdown.
Okay, now for our next indicator. I want you to burn one single number into your brain. Just one. That number is 50. 50. It's the magic number, the key to understanding one of the most important forward-looking indicators out there. That number, 50, is the center line for the Purchasing Managers Index, or PMI. Now, this isn't a hard number, like factory output. It's a survey. Every month, they ask hundreds of business managers a simple question: is business getting better or worse? If the final PMI number is above 50, it means more managers are optimistic and see things expanding. If it's below 50, it means the overall sentiment is negative and things are contracting.
It's a brilliant vibe check for the entire economy. All right, so we've covered the big macro forces, the view from 30,000 feet. Now let's zoom all the way down to the individual companies. It's time to talk about that chaotic, exciting time of year when every company has to show us their report card, earnings season. 4 times a year, like clockwork, every publicly listed company has to open their books and tell the world how much money they made or lost. As you can see, these periods are completely predictable and they create a ton of buzz. The market gets super volatile as traders and investors try to guess what the numbers will be. But here's the absolute #1 rule of earnings season. The final profit number a company reports almost doesn't matter on its own. What truly matters is how that number stacks up against something called the street expectation. This is basically the average guess from all the top market analysts. The whole game is a battle between reality and expectation.
And this leads to 3 classic scenarios. First, an earnings beat, where the company does better than expected. The stock price usually pops. Second, an earnings miss, where they do worse. The stock usually drops. But here's the weird one. What if they hit the expectation exactly? You'd think that's good, right? But often the stock goes nowhere or even drifts down, because the market thrives on positive surprises, not just meeting the baseline.
Okay, we've talked monetary policy, economic data, and company earnings. But there's one last piece of the puzzle, and it's the most unpredictable of all. These are the wild cards, the bolts from the blue that can completely hijack the market's narrative.
And these can be literally anything. The annual national budget can introduce a new tax that clobbers an entire industry. A war on the other side of the world can send oil prices through the roof. A global pandemic, as we all know, can change absolutely everything. Even domestic politics, like a major election, can create huge uncertainty that makes investors nervous. You can't schedule these, but you absolutely have to be aware of them.
So let's bring it all home. What are the key takeaways here? First, the market moves on a lot more than just company news. It reacts to the whole world. Second, the central bank is the biggest driver, using tools like the repo rate to speed up or slow down the economy. You've got to track the vital signs, CPI for inflation, IIP for industrial output, and of course, PMI, always watching that magic 50 mark. When it comes to companies, remember, it's all about beating expectations. And finally, always keep one eye open for those unpredictable wildcards.
Look, understanding these forces is the first real step to making sense of the market's madness. It's not about having a crystal ball to predict the future, but about having a dashboard to understand the present. So, now that you know the signals, the real question is, which one are you going to watch first?